Well, I think the Q3 GDP data will still be very interesting just to figure out sort of how, just how bad the current economic situation is, because obviously something triggered that pivot in policy that we saw a couple of weeks ago. So the question is, did the leadership see something in the economic data that maybe we haven't seen yet? I mean, we all know that the economy is doing badly, but actually it seems that in Q3, as far as we can tell from the data we have so far, that in Q-on-Q terms, momentum maybe actually have improved slightly. Of course, there's a risk that that may not be the case, and so it'll be interesting to see what the Q3 data show.
Vikas?
Julian, one more question from my side. I'm going to cheat a little and relay a question to you that she asked me. When it comes to the market expectations, 2 trillion, 10 trillion, some number in between, is there a number that suffices to sustainably lead to equity participation from investors? Or do you think that the direction is enough, that the magnitude perhaps means less now than it might have, because we have seen a clear change in direction over the last 2 to 3 weeks?
Well, I think the numbers do matter. And I think the key context here is that in the past, when you look at China's stimulus packages, obviously people tend to focus on the fiscal side, but there really have been 3 engines: fiscal, property easing, and monetary support, and a big pickup in credit and bank lending to the private sector. Now, in the past, all those 3 engines have been working in tandem, and that's why you've had these strong cyclical recoveries in China. This time, the credit engine and the property engine are essentially not working properly. The transmission mechanism is broken. And so you need fiscal to come in to a much greater extent than what we've seen in the past to get that same cyclical recovery. And that's why the magnitudes here are important. It's hard to put a specific number on it because obviously there's a lot of talk about recapitalizing the banks, dealing with the existing debt problems among local governments. But if a lot of the additional borrowing goes into those areas, it actually does not stimulate current demand that significantly. So what we really need to see is, at least in our view, 2.5 trillion of new additional borrowing next year on top of the baseline that goes into new spending. And that, in our view, would be just about sufficient to keep growth around the 5% target both this year and next year. Anything less than that, and I think the risk really is that the economy just continues to slow next year, given all the structural headwinds that it faces.
All right.